everyone. My name is Patrick McCarthy, and I'm the Policy Advisor here at Veal Farmers of Ontario. Welcome to VFO's Managing Risk, Mastering Markets on-demand webinar series. This series is designed for grain-fed veal producers and offers expert insights and practical strategies to effectively navigate the complexities of today's market dynamics. Joining us today from the Ontario Ministry of Agriculture, Food and Agribusiness is Chief Economist Steve Duff. Today, he will share an update on the North American cattle market and highlight key trends from the past year and where 2025 appears to be headed. Over to you, Steve.
All right, so again, I'm going to go through a situation outlook for the veal industry here in Ontario. As Patrick mentioned, we are part of a North American industry. I think, all know that more now than we ever have with what's going on with Donald Trump, et cetera. I'll try to reflect on that as we go. But we are a price taker in all of our major commodities, beef and veal included. And so seeing where the U.S. is going is a major driver of that. I think we all know, for those of us that are involved in the cattle industry in different forms, that we've seen, basically the herd size declining both in Ontario and Canada, across the U.S. There's some discussion that the U.S. might be just starting to rebuild a little bit. But the reality is that pasture-based industries struggle for a variety of reasons, competing for land with corn and soybeans in particular. The challenges that we see with an aging farm population, as well as drought. And I'll talk about that a little bit here in a bit. But the U.S. is really in its fifth year of contraction as far as the cow herd is concerned. The Canadian cow herd has declined about 32% since BSE. If you look at the January numbers, it's down a little bit as well. The Ontario herd has fallen about 45% since BSE. Our July numbers this past year were down about 1%, and we're pretty much flat in the July number, or in the January numbers now. So we're not seeing major declines necessarily. We've arguably flattened. Will we see a little bit of a rebound? It's possible. I'll talk a little bit about that. But what this basically means is that the number of cattle that are coming through our feeding systems in the North American industry is really not going up. And that's going to play into a number of things, including challenges on the production side. When you look at the U.S., again, the U.S. in the last, and this is again kind of ironic given the way Donald Trump has approached the world recently, but certainly in the agricultural complex, the grains and the livestock complex, they're very much focused on exports. Exports has been the major driver of growth in the United States. Pork and chicken production in the U.S., which they export an awful lot of, contained industries relying on processed feeds. They've risen over 50% in the last 25 years. And, they're flat, if not declining a little bit from the beef side of things, the pork side of things going up just a little bit. But really the U.S. in the broader context for us in Canada, at record production year over year, the last 10 years or so. And a lot of that is requiring exports, access to markets, being able to deal with excess supply. What you've generally seen in again, the major livestock industries, with cattle and pork in particular, you've seen the cycles flatten. The bottoms are not quite as low as they once were of the cycle. The tops are not quite as high, in particular with pork, which obviously has a shorter gestation period than cattle. So the cycles tend to be more come sooner, if you will. The peaks and valleys have really gotten cut off, and it's exports that have done that. And again, when the U.S. has excess production, when prices are cheap, exports increase, and when prices get high, you see the U.S. pricing themselves out of markets, et cetera, and exports start to fall, and the cycle, if you will, starts to rebound. But they're at excess production, they're at maximum production right now, and that plays into a number of the dynamics in the industry and how that affects prices. And one of the ways that plays into it is that the drought, in particular, when we're talking cattle, can have a much more profound impact. And so if you look at the drought monitor right now in the United States, obviously we've got planting going on both in Ontario, Canada, and the US. So there's a lot of expectation. We know how much crop we had last year. We're dealing with what we have. Our feed stocks are effectively are fixed now until the fall. But drought has a major impact. One, in terms of the growing season. So you've got right now about 20 to 30% of the corn, soybeans, and winter wheat area in the United States in drought. So that can affect a number of things. If you look at where prices are going and where they've been, the reality is that the US, if they want to keep prices relatively stable, they need strong yields. If yields fall much below current levels, and drought can significantly contribute to that, that's when we start to see the upside on price. And again, in a feeding industry like veal, that's a major issue. The other aspect of that is that on the feeding side, as far as livestock goes, the grazing side of things, about 30 to 40%, depends a bit on the area, of the sheep, cattle, and hay areas, and there's a fair bit of sort of commingling of those areas in the US, are right now in a drought. And that's significant because, as we know, somebody that pastures cattle, you're starting to move animals out on the pasture this time of year. This is where, you need that spring growth, you need the moisture levels, and that sustains you through into the summer, where a lot of your early season gains are occurring. In the US, because they have major areas of the US, the Panhandle up through, parts of Texas, et cetera, into even up into Montana kind of thing, the US doesn't have contained livestock when it comes to cattle to the same degree. And as a result, when you have early spring drought, that can significantly stunt growth in cattle. It can significantly move what is a normal move of cattle off of grass into feedlots, or even feedlots into the packing industry much sooner. And that can have a big impact on short-term meat prices. And that, I think, is pretty significant, in particular from the veal industry, where you're dealing with an animal that comes into its slaughter weight much sooner than if you're talking a fat animal in a normal feedlot circumstance. And so then we couple that with demand. And even though, we continue to see food prices overall being high, we have seen inflation and food inflation come down, getting to closer to more what we consider normal levels, et cetera. The reality is that food prices continue to be high. And that's certainly the case when it comes to meat and beef and veal in particular. But despite that, meat demand overall is growing. And that's, a combination of population growth in Ontario, across Canada, and North America, as well as the fact that the demand for lean protein is part of a growing consumer that's interested in health, a consumer that is eating more food at home, some because of COVID, some because of cost, et cetera. Lean protein plays into that pretty significantly. Excuse me. And that's, again, where veal starts to continue to have a market opportunity. If you look at per capita demand, the amount that people consume per individual, chicken is really the only meat that we've seen a sort of sustained growth year over year in per capita demand. And that's, again, a function of a variety of things. Certainly in the Canadian context, some of it's supply management in terms of the stability of production that it offers. But in reality, a lot of it has to do with the simplicity of cooking, the size of portions, the consistency of the product, et cetera. And that isn't something you see to the same degree in other meat products, maybe the same degree. When we look at veal, so veal is basically the blue line on these graphs, the dotted line in each case. That's the left-hand side is total consumption of veal in tons in Canada over the last 25 years. We're a little bit lower than where we started it in 2000, but we're starting to come back up. And so what that's saying is that, we're bucking a trend. We're seeing on the right-hand side, the blue line, where per capita demand for veal is falling. But the increase in population is offsetting that. And so that's important to understand what the total demand in the marketplace is. That's why we continue to see strength in prices, because the aggregate demand for the product is still there. If we were seeing per capita demand going up also, we'd see a bigger increase in that, and we'd even see higher prices because of how that plays into demand in the marketplace. The other part of this is that veal imports are a pretty significant part of the value chain. And so again, veal imports are about 12% of our overall demand in the country. That's lower than beef overall. It's lower than pork, interestingly enough, even though we produce so much extra pork. Veal imports are, quite significant, but still not maybe to the same degree as some of the other meat complexes. That's also good, because it implies that there's a greater opportunity in the domestic market, and that also, I think, implies that there's an opportunity to displace those imports if we can continue to have volumes of supply to meet that demand, which again and especially in the fresh market, is very much just in time. If you look at Ontario, we're only supplying about 40% of our veal consumption. So there is a difference in the nature of how veal is produced, obviously, and where it meets demand across the country. If you look at Ontario, we're importing about 3% of our veal consumption from international sources, and the remainder is interprovincial, and a lot of it is coming from Quebec. So again, there is a just-in-time nature to this. There's the nature in how veal is packaged, certainly in a commercial retail sense. I'll talk a little bit about that. All of those, again, continue to suggest, I think, a little bit like sheep, that there's an opportunity from a domestic supply point of view to continue to strengthen the Ontario market, to try to push some Quebec product out in certain circumstances, especially in the more local direct-to-consumer model, as well as to compete with international sources. Interestingly enough, our veal imports into Ontario fell by about 50% in 2024. And if you look at the data, 2022, we saw about a 40% increase in veal imports. So a big jump, because our numbers were down. 2023, relatively flat, and we've seen imports fall again. And so again, that's a function of a variety of things, some of that changing demand, the nature in which we're sort of substituting product. As I mentioned, the reality is that our number of cattle is relatively limited. We're not seeing major increases. And in addition to that, certainly from the context of fed cattle, we really don't have a definitive on cattle on feed number for Canada or Ontario like there is in the United States. And so, we're trying to understand what is the number of cattle on feedlots and how does that play into things. And again, because grain-fed veal is a product that has different substitutabilities, that's an important thing to consider. The reality, I think, for Ontario is that without Western Canadian stocker cattle imports, we wouldn't really have the same feedlot industry we do. My estimate is that about 40% kind of over time of our fed cattle in Ontario on our feedlots has come from Western Canada. My estimate for this year is about 42%. So it's up just a little bit. And I would say if you look at the numbers of cattle going into placements right now in Ontario, my gut feeling is that would be pushing close to 44% for the 2025 year that we're in right now. In addition, since BSE, we've been moving about 8% of our cattle to the south, and that's changed a little bit. The numbers have dropped off in the last couple of months a bit because of what's going on in the U.S. Not so much because of tariffs, but just because of some of the uncertainty. And we don't have as many cattle around. 2024 was estimated about 14%, which was up about, I should have 24 there, not 23, which was about 98,000 head. So that's a pretty significant increase in 2024. And again, the last couple of months, it's starting to back off a little bit. What we've seen, however, and this has kind of been the common case for Ontario, is that the number of fed cattle and total slaughter, the difference there, is usually filled by cull cows coming out of Quebec and coming into federal plants. Historically, Cargill and Guelph will run a lot of times a day a week on Quebec cull cows. And again, they're producing a different meat product. And again, in today's environment, ground beef is much more in demand. It's been one of the ways that beef demand has been able to stay relatively stable given increases in prices. So that's an important feature, and that plays into the overall demand, and how we're able to meet that with a supply that's constrained. And so again, when you have strong demand, climbing overall demand, you have a demand for higher levels of lean protein. We have lower inventories. As everybody's seen, we're able to try to counter that, and we're doing that in a variety of ways, but in particular through increasing carcass weights. And so the interesting thing is, even in veal, where you've pretty much got a sort of a maximum weight as far as what a veal animal is, where you don't have that in the fed cattle side of things, we've seen a pretty big increase over time. So since 2000, we've had about a 12% increase in fed cattle carcass weights. We're in Ontario right now. We're up over 900 pounds on the rail on average so far this year. That's a massive increase. If you go back to 2003 and look at the numbers, you're talking 60 to 70 pounds a head increase compared to where we are today. That's a big jump in 20 years. And that has helped offset the lower number of cattle. But in veal, it's risen even further, which is a function of the fact that veal is only, for the most part, processed in provincial plants. There's a lot more direct or custom cut kind of process in terms of veal numbers, that kind of thing. But that's still a pretty big increase with more and more, and it's getting closer and closer, at least on average, to that maximum veal weight, which defines veal as again, a unique animal relative to something up into the fed category. So if you look at the veal slaughter numbers in Ontario, there's a few things that stand out. One is that, all of the provincial or all of the slaughter is provincial. That's been the case for a little while now. Will continue to be the case, I'm guessing. In 2024, we saw veal slaughter decline by about 7%. So that's a pretty big decline. Again, that's largely a function of availability. There was, again, no reported federal slaughter. Year to date, and this can play out in different ways as the year goes on, but year to date, we're down about 14%. And so, again, generally speaking, we're talking probably about 90% or so the cattle being veal sold in auction are coming through slaughter. The rest are coming direct into the slaughter plants in different ways. So, those are pretty significant in terms of a decline, and hopefully as the year goes on, we can regain some of those numbers. There isn't great data on veal prices like there is for beef prices, etc. So I want to talk about the beef side of things a little bit, and then I'll get into a little bit of data on what I can sort of tease out on veal. But again, we're kind of using the start of COVID in a lot of sectors as a reference to kind of see where we're at right now. And it's really quite interesting. If you look at where fed cattle prices have went since January 2020, they've risen about 80%. The wholesale price of beef in Canada has risen about 47%, and the retail price has risen about 37%. And again, the context of what retail price means is an interesting one because, again, different cuts play into that quite significantly. The demand for ground has really increased, and so that plays into that as well. If the proportions had stayed sort of the same or followed the carcass proportions of cuts the way we would traditionally think of them, you'd see a much higher increase in retail price and wholesale price as a result. So there's a number of factors that play in there, but again, they've increased quite significantly. We know certainly that's the case. This slide looks at the three main proteins, beef, chicken, and pork, and tries to look at their prices as time has went by as a ratio to kind of see where they fit in terms of value and understand sort of relative performance. The dark blue line is the ratio of beef to pork. That's increased a bit lately, which is basically meaning that beef prices have jumped higher than what pork prices have. The sort of the middle blue line, which is close to the dark line, that's the beef to chicken ratio. And in that case, it's jumped a little bit recently. And again, largely what we're seeing is the price of beef going up more than the price of chicken. And then you see the lighter line, which is the chicken to pork ratio, that's declined a bit. And that's largely because the price of pork has fallen. And so, interestingly enough, chicken and pork, I think right now and have for a while, are probably more affordable than beef overall, depending on how you're consuming your beef. If you're consuming it solely as ground or largely as ground, like some people are, that can sort of balance that off. But pork and chicken are pretty affordable in that regard. So as I mentioned, with from the veal price side of things, we don't have very good data on price data. At best, you can really sort of follow major grocery chains, et cetera, try to follow similar products. It's pretty variable in terms of what's offered, what's available on the veal side of things. So if you're a producer producing veal and you want to understand retail veal cuts, I think, in terms of ground or loin chop, which would be the two sort of main products, I think finding a local source, whether it's a local butcher, local processor, somebody that you could, talk to regularly to get a feel for that and sort of track it yourself, I think is a pretty good thing. If you, sell direct to consumer meat, like, I do, like, I think that is one of the things that's a good tell for you. But, we can look at import prices because we do import some, and that gives us a bit of a tell for that. And there's a few things we've seen. One is that boneless and fresh cuts have risen significantly since 2000, which I think is consistent with the reflection that veal is still a part of the beef value chain. Beef prices worldwide have increased significantly, so that's not surprising. What we've seen is that in particular for the import side of things, the boneless fresh cuts and boneless frozen cuts were up consistently about 15% in 2024. Um, and so that's actually fairly consistent with what we've seen as that floats through to the retail side of things. Um, I had done this presentation originally back in March, and so I'd done that particular data point in March 3rd, looking at Ontario ground veal prices across various retail prices. And what I found was is that prices for ground veal varied in the neighborhood of about $1.70 range, so anywhere from 17 cents, $17.70 a kilo roughly, up to about 19.40 a kilo. And that was up about 15% from March 3rd of last year in 2023. So it followed that import price change quite a bit. Interestingly enough, like last year when I did this same presentation, we were generally about $1.50 a kilo higher than the ground beef side of things. So again, that sort of relationship, tracking, et cetera, I can't, speak to the decisions of the meat counter staff at various retailers, but it seems to follow that sort of general trend. On the loin side, I wasn't able to get as good and clean data for Ontario, but I sort of anecdotally saw again about a 20 to 25% increase on the loins, which again is a bit of a fresher product, and a priced at a discount um, to T-bone steaks, which I kind of saw as an equivalent product as far as the type of cut goes. So again, similar relationship, but I think again that import side of things is a relatively good tell for where the retail side of things go in the Ontario veal market. Um, Again, veal like sheep is unique in that, a lot of the veal, again, that's sold from the farm is sold through a live ring that the animal is going direct for slaughter. So veal and sheep are pretty unique that way. If you look at fed cattle in Ontario, the majority of the cattle are sold direct to packer, so you're not going through that auction. So that's unique. And so what we did see is that the auction values in Ontario, the number in sales fell about 5% to the lowest level we've seen in a little while. They averaged about 512 head a week through 2024. The largest year we'd had from a per week volume was 2019, where we were running about 690 weeks. So we're down a fair bit from that. If you look at where we're at today, year to date, we've averaged about 514 a week, which again, so that's up about 4%. Which is interesting because, as I mentioned, the slaughter numbers are down about 14%. So there's a bit of a disconnect there. So does that mean some of these animals are getting back into a feeding environment for a short keep? I'm not 100% sure. We'll see as the year goes on where the data goes in that regard. So that's also an interesting one sort of to follow, given that veal can move out of that category relatively easily. So when we look at markets and we try to understand where we're going locally relative to, the US in particular, which drives our market, we're a price taker to them, as I mentioned. We tend to use a term called basis, or you could also call it spread. And in this case, what we're typically doing is looking at how the Ontario market is moving relative to a US market. And so, like in corn, soybeans, cattle, hogs, we use the futures market out of Chicago as a tool for that. For other commodities, take sheep, for example, we use reference prices out of major auctions in the US as a tool for that similarly. And so the basis kind of gives you a spread. When the basis is really low, when it's negative or considerably lower than the US, that tends to mean you've got a lot of supply in the market. We might be exporting, we call it an export basis, and so on. When it's high, when it's above a zero, when it's a large number, that tends to mean we're importing, et cetera. And that's basically what we've had on the bobcalf side of things. Now, the dotted line represents that average basis over the last 5 years. And so there's parts of the year, at the start of the year, January through February, it's pretty much even close to zero. And then as the summer goes on, as the supply tightens, you see that number increase, average of 200 and then sort of float after that. Never getting much above 200, at least on average over the last 5 years. at the end of 2023, 2024, and through 2025, we're into, uncharted territory, I think, as everybody who would be listening to this knows. The basis as we've defined here, which is on a per hundredweight basis, so basically per calf, if you assume a bob calf weighs roughly 100 pounds, it's massive, right? We peaked, week 21 roughly of 2024 at about $800 over US, which again, is a massive increase. And, at the end of 2024, I think there were people, myself included, thought, well, maybe the market with Trump and et cetera, things that are going on sort of pushes it back down. But as you can see by the lighter blue line here, it's stayed above that 2024 level. And it's a little bit of the to the moon, Alice, kind of where we're at right now, hitting just over $1,000 a few weeks ago. And so that again is a significant thing. It's indicating low supply, it's indicating strong demand, and it's indicating a very specific market, which veal is. And as a result, you've got that strong demand that reflects in that blue number. And so where that number goes relative to last year, and when it starts to cross that darker blue line like last year, that's when, if you, in a lot of commodities, if it was to cross last year, start to come down below that, you'll tend to move down to the average. In normal circumstances. I don't know this is normal. And so again, that's something to sort of keep an eye on. If you look at the veal side of things, so this is, the last slide, sorry to go back, this basis is related to the feeder cattle futures market is the way we tend to do that. And then on the veal side of things, then we're relating it to the fed cattle futures. So that would be similar to how we do it with fed cattle futures. Again, the veal side of things is a little bit unique in that, again, it's a specific weight, it's a specific sale model, which is auction, and it's going for slaughter. So that does change the dynamic of it, and it's a little bit similar to the fed cattle live auctions. We have a couple here in Ontario once a week. But again, similarly, the basis took off in the fall of 2024 and has stayed high until recently. And so as you can see, we're negative for a lot of the year on average, which tends to mean that from a veal perspective, we've got excess that it's having challenges competing in the market. That tends to be why you're negative on the output side here. But 2024, we saw big strength, but we saw that come back down. And as you can see, the lighter blue line has crossed that dark line. So again, that would tend to mean that we'll start to, even in this case, dip below that 5-year average. That makes it tricky because you're looking at how this moves forward as somebody selling a veal animal, knowing that if you're going back to that graph, 34, 36 weeks earlier, you're having paid that high basis price. And we're seeing that in a variety of different ways. And so if you look at the average price for veal and bob calves, over the last 20 years or so since BSE, it's a crazy graph to look at, right? And there's some commodities that are similar, but this is a pretty extreme one as far as that last couple of years. So veal prices on average were about $287 a hundredweight in 2024. That's $64 over the record, which was 2023. The record before that was back into 2015. So again, you're dealing with some big numbers here. On the bob calf side, we averaged 890 last year. That's the record and almost double the previous record of 2023. And almost double the record prior to that, which was 2015. Again, back then, a period where we're coming off major US drought, short numbers of cattle, etc. Year to date, 2025, our veal calves have averaged about 280, so a little bit down. But on the bob calf side, we're averaging almost $1,100 a hundred, so per calf effectively. So you're up almost, you're up about $200, even above what was a record year last year. So, you're very much into uncharted territories again, and that will have a big impact, especially if we see veal prices start to fall a little bit. And so recognizing that this is a feeding industry, it's a margin-based industry. What I'm paying today for my animal, I have to figure in the feeding period and the period that the price is going to change over that. But, for the most part, for grains and oilseed products, we're really seeing relatively flat expectation of price over the next year. As I mentioned, the US is predicting, their first prediction came out this week for what their sort of real 2025 crop year would look like. They're talking record production, but not necessarily big drops in price relative to where we are today. And so, that current price levels is sort of driving demand a little bit on the corn side. Soybeans somewhat similar, but I think from a feeding point of view, recognizing that, sort of flat prices are here for a period of time, which again, might give you an opportunity as a buyer to hedge a little bit to protect yourself in the event that we did see big jumps in the next year. Again, if we had more drought, et cetera. But I wouldn't see major declines necessarily in the future. If that is the case, the way that will happen is either, a bigger trade war with China, which would drive prices down for a short period of time, or if we had major bumper crops in the US, and I'd say that's pretty unlikely. So again, I think flatness as far as your feeding costs go are probably likely. On the feeder cattle side, again, I think we're flat and increasing. There isn't anything to tell me that you're going to see downward pressure, significant downward pressure on the price of stockers, whether it's 5 or 9 weight, and that translates again back to the bob calf side of things. The volumes of cattle are just not there. Even if we were to see rebuilding, is years now, and I don't foresee enough rebuilding anytime soon in the U.S. in particular to really start to push prices down. I don't think the economics of rebuilding are there for a lot of people. And, when you can get 3 years worth of income out of one heifer, it's hard to keep that heifer back. And so I think that is going to continue to be a challenge. On the fed cattle side, again, you're competing against a complex of meat that has other competitively priced retail products. But the reality is that the consumer has a cheaper alternative in beef, which is again ground beef as a cut, if you will. And so again, I think that's suggesting that from a fed cattle rail perspective, again, relatively flat prices with a bit of seasonality in there. I know we're a bit above 420 right now. We're about 480 on the rail. But I think we should expect that to start to fall a little bit as the summer comes on. We would normally expect that anyways, with a bit of a rebuild in the fall. And again, not major declines, but also not major increases. So again, from a feeding perspective, I think that kind of, from a feedlot point of view, helps guide where you might go in terms of pricing, in terms of buying. So this is the feeding margin that I've forecasted right for the next year. And so this is basically selling a veal calf over the next year, and this is on the basis of what I would have paid for that animal in any particular week and moving that back 36 weeks roughly. So it's based off of what we use for the RMP program as far as the purchase cost concept. Again, knowing that you have a 34-week feeding period and the cost of feed over that 34 weeks, which is the lighter blue bar. And you can really see it in the numbers where we saw that sort of big jump. I talked about it with the basis on bob calves, and that's because there was a big jump in the bob calf price in auctions across the province. That means that in basically the veal calves starting to come out here in June are really coming out at a much higher price profile as far as that input bob calf price compared to any veal much before that, at least on average. And that has a big sort of dropping impact on your margin. Your feed costs are not really changing a whole lot. They're about 480 or so ahead, roughly in that neighborhood, not varying a whole lot. But that margin comes down because you paid significantly more for that animal. As you can see, that steps up again as the remainder of the year goes because we're continuing to move. As I mentioned, we're already $200 a bob calf higher on average right now than we were last year. And so that means bob calf, veal calves being sold 34 weeks from now, we're going to, be that much lower on a margin basis. But given where prices are at, you're still in the neighborhood of a margin of about $400 to $500 per animal to turn, again, you've got overhead and a bunch of other things in that, cut costs, et cetera, depending on your business model. So still relatively healthy margins. But the margin coming down quite a bit compared to, sort of the economics, I think that's been driving some of the cash flow that's led to bob calf prices to where we're at. So, that said, I would suspect that starts to pressure the bob calf side of things a little bit as people see their cash flow come down fairly substantially as we hit middle of the summer, closer to May here. So that will, I think, be a major driver, and that's pretty common, I think, in the feeding industries. I think we're we're going through a pretty positive period from the veal perspective in terms of pricing. But again, I think that, high prices can, kill high prices. And I think that's starting to play into it a little bit in terms of the cash flow that's available to producers as we see those bobcalf prices get to that level. So again, still relatively strong margins historically, but I see them coming down a fair bit over the remainder of the year. And I think that's going to temper decisions a little bit. So with that, I'll end my presentation and turn it back to Patrick.
So thank you so much, Steve. Your presentation provided some critical insights that will help veal producers as they navigate market uncertainties and plan for sustainable growth. FO also has great tools for monitoring markets, including our newly updated Veal Market Report app that is now available to download for Apple and Android devices. A PDF version of the market report and additional analysis is available on vealfarmers.ca/market-information. VFO also produces the Veal Trade Tracker quarterly for producers looking for a straightforward picture of the state of the veal trade and the impacts changing trade conditions have on your operation. We encourage you to check them out. To our viewers, if there's anything you would like clarified, expanded upon, or have a question about, please email us at events@vealfarmers.ca, and we'll get those questions to Steve, and we'll share his responses in our Finishing Grain-Fed Veal in Ontario private Facebook group. Thank you very much for watching, and be sure to visit vealfarmers.ca/on-demand to find more webinars in this series.